Hey everyone, welcome to today's Explainer. I am absolutely thrilled you're here with us for this AP Business and Personal Finance lesson. We're diving into a topic today that completely shifts the way most people look at businesses. We're going to demystify one of the three most important financial documents in the entire world, the cash flow statement. Now, I know it's a concept that sounds kind of complex at first, but once we break it down, it just clicks. So let's get right into it. So, what if I told you that a business could actually make millions of dollars in pure profit and still end up going entirely bankrupt? I know, it sounds totally impossible. How can a highly profitable company just shut its doors? I used to think the exact same thing. It really feels like a paradox, doesn't it? Take a second and let that really sink in. Well, as impossible as it sounds, that paradox happens every single day in the real world. And the reason? Profit is simply not the same thing as cash. When a profitable business suddenly finds itself with the lights switched off and confused employees standing at the locked doors, it's almost always because they simply ran out of actual money. In financial terms, we call this cash flow. Understanding that profit does not equal cash is the absolute crucial starting point for today's lesson. Here is our roadmap for today. First, we'll look at the profit illusion. Second, we'll define cash flow. Third, we'll break down the three sections of the statement. Fourth, we'll walk through a real business example. Fifth, we'll cover common mistakes. And finally, we'll wrap up with some AP exam practice. All right, part one, the profit illusion. Let's see why profit doesn't always mean cash. To really understand why a profitable business can fail, we've got to step into the shoes of a business owner. It is just so easy to look at a spreadsheet and think everything is going great, but the numbers on paper can sometimes be a beautifully disguised trap. Just imagine you own this fantastic little cafe. It's been a super busy month. You've made AED 120,000 in sales. Your expenses for the month were AED 90,000. So your profit is AED 30,000. That's a fantastic result. You're profitable. But let's look at the reality of the situation. Your biggest corporate customers? They haven't actually paid their invoices yet. Meanwhile, your coffee bean suppliers need to be paid today. Your employees are expecting their salaries tomorrow morning, and your rent? Yeah, that's due next week. You open your bank account to pay everyone, and you only have 2,000 dirhams sitting in the bank. Can you pay your staff? No. Can you pay your rent? No way. Even though your business is highly profitable on paper, you're actually in a massive crisis. Remember, profit is not the same as cash. Your cafe could literally close down tomorrow just because you don't have the cash to survive the week. Moving right along to part two, defining cash flow. Let's talk about tracking the fuel. To avoid failing despite being profitable, businesses track their cash using the cash flow statement. This is a financial statement showing cash inflows and cash outflows over a specific period. Think of it exactly like opening your banking app on your phone. Your banking app doesn't show you the money your friend owes you for dinner last week, right? It only shows the actual hard cash moving into your account and moving out. Unlike a balance sheet, which takes a static snapshot of one single date, the cash flow statement tells a dynamic story of how cash moves over time. And why is tracking this so vital? Well, because businesses use cash for absolutely everything. Paying employees, buying inventory, purchasing equipment, repaying loans. Cash is the absolute fuel that keeps the business engine running. I want you to imagine a beautifully engineered luxury sports car with zero fuel in the tank. It looks incredibly impressive sitting there in the driveway, but it simply cannot move. A business without cash is exactly the same. No matter how profitable it looks from the outside, without fuel, the engine just stops. Okay, part three, the three sections. Let's look at how we categorize all of this cash. A proper cash flow statement is incredibly organized. It breaks everything down into three distinct sections: operating, investing, and financing activities. Every single dollar that enters or leaves a company is going to fall into one of these three buckets. And here's a fantastic AP exam tip for you. When investors open up a company's financial reports, this is usually the very first place they look. They want to see exactly where the cash is coming from. So let's break down each of these three activities one by one. Let's start with the most critical section: operating activities. This is the cash generated or used by the daily fundamental operations of the business. When you review this section, it answers one vital question: can this business actually generate cash from its normal day-to-day work? Examples of cash flowing in would be customers paying at the register. Cash flowing out includes paying your employees their salaries, buying daily inventory, or paying the monthly rent and utility bills. Next up, we have investing activities. This section shows the money spent on long-term assets. You can really think of this as the business investing in its own future growth. If a company decides to buy a new warehouse, purchase heavy manufacturing equipment, or even buy a fleet of delivery trucks, the cash flowing out to buy those items is recorded right here. Conversely, if the business decides to sell off an old piece of machinery they no longer need, the cash coming in from that sale also falls right under investing activities. The third and final bucket is financing activities. This tracks all the cash that involves the business's owners and its external lenders. Essentially, it shows how the business raises its capital to survive or expand. If a company goes to the bank and takes out a massive loan, that cash inflow is recorded here. When they eventually pay that loan back, the cash outflow is recorded here too. It also includes issuing new shares of stock to investors or paying out dividends to shareholders. All right, part 4, let's look at a real business example. Let's put this into practice and see how these sections actually interact in the real world. Imagine a bustling local bakery. First, let's look at their operating activities. They received AED $180,000 from customers, but paid out AED $70,000 in wages and AED $40,000 to suppliers. That leaves them with a positive operating cash flow of AED $70,000. Excellent. Now, in investing activities, they bought some brand new industrial ovens to expand the kitchen. That cost AED $45,000, so that's a negative cash flow for investing. Finally, under financing, they received a bank loan of AED $30,000, but paid back AED $10,000 of an older loan, leaving a net positive of AED $20,000 in financing cash flow. So, what is the grand total for our bakery? We take that positive $70,000 from operations, minus the $45,000 spent on new ovens, plus the $20,000 gain from financing, and we get a net total increase in cash of AED $45,000. That positive number means at the end of the day, our bakery has 45,000 dirhams more in its bank account than when it started the period. The formula works perfectly. Part 5, common mistakes. Let's make sure you avoid these traps. Now that we've seen a flawless example, we really need to address the pitfalls. Being aware of these will immediately put you ahead of the curve. The number one mistake, as we discussed right at the top of the explainer, is thinking profit equals cash. They are fundamentally different things. The second mistake is ignoring negative investing activities. Students often see a negative number in investing and immediately think the company is doing poorly. In reality, buying new equipment reduces cash today, sure, but it signals future growth and increased future earnings. And the third mistake, thinking that receiving a bank loan increases profit. Loans increase your cash balance, yes, but they absolutely do not make you more profitable. And for the AP exam, always carefully distinguish between your income statement, which shows profit, your balance sheet, and your cash flow statement. And finally, part 6, AP exam practice. Let's test your knowledge. All right, let's play a quick detective game. I'm going to give you a scenario, and you have to tell me which of the 3 cash flow sections it belongs to. Ready? Question 1. Which section of the cash flow statement includes paying employees' salaries? Is it operating, investing, or financing? Take a quick think. And the answer is operating activities. Yes, paying your staff is a fundamental day-to-day function of keeping the business running. Great job if you got that one. Let's keep that momentum going. Question 2. What if a company buys a new building? Where does that go? That's right. Buying a building is a long-term asset, so it belongs in investing activities. And what about receiving a new bank loan? Exactly. Loans involve outside lenders, so that goes straight into financing activities. If you can quickly categorize transactions like this, you are going to absolutely crush this topic on any exam. To wrap up today's explainer, I want to leave you with a highly practical, real-world toolkit. Whenever you're handed a cash flow statement in the future, just follow these 3 easy steps. Step 1. Look at operating cash flow first. Ask yourself, is the business generating cash from its daily operations? If this is consistently strong, it's usually a very positive sign. Step 2. Check investing activities. Are they actively spending cash to invest in future growth? And step 3. Review financing activities. Is the business surviving on its own revenues, or is it relying way too heavily on taking out loans and raising new money? Today, you learned that cash, not just profit, is what truly keeps a business alive. You now understand exactly what a cash flow statement is, its 3 distinct sections, why profitable businesses can still fail, and how to analyze cash movement. It is honestly one of the most powerful analytical skills you can develop. So, now that you know cash is the true fuel of business, which real-world company's cash flow statement will you investigate first? Think about it. In our next explainer, we'll explore financial statement analysis, where you'll learn how investors use all this data to make smarter decisions. Until then, stay focused and keep learning.